Tchaikovsky, and welcome to my Goodwill question. So, what exactly is Goodwill? Well, Goodwill is going to be when a company purchases the assets or the business of another, and they end up paying more than the fair value of the assets. The best examples I can share with you of examples of Goodwill would obviously be the first one that's immediately coming to mind would be Disney. So if we take a look at Disney's balance sheet and I look at their most recent quarterly report, we notice over here that on their assets for the Walt Disney Company, that of the 196 billion of assets right over here, approximately 73 billion is goodwill. And they have intangibles of about 9.6 billion. So the question becomes, where did this come from? Well, if we look at the history of the Walt Disney Company, they purchased Fox, 20th Century Fox, which is how they got the content for The Simpsons, Alien, Home Alone, among other properties. That was a big chunk of the goodwill. They also purchased Lucasfilm. They bought Marvel and an initial acquisition, and obviously by acquiring Fox, they got more parts of Marvel. So, but what exactly is goodwill? Well, goodwill is when we go through and we say we purchase, when say if we buy a company, and again, I'm going to make up some numbers. So Disney buys Fox, or let's see what the actual purchase price was. So they basically paid 71.3 billion. So right over here, when we go basically for 71.3 billion, what would happen would be is that essentially they would send in appraisers. And remember, when Disney purchased Fox, they did not buy Fox News. They did not buy the studio lots or any of the physical properties. They were buying all the intellectual property. They also, I think, acquired whatever Fox owned and who. So the thing you do go through and do is you basically say, okay, we're going to hire some appraisers. The appraisers are going to say, okay, well, the value of the Fantastic Four, Marvel, the Star Wars parts that we didn't know, the Alien franchise, will say that this has a value of, say, intangible assets, basic copyrights and the like. We'll call this 10 billion. Again, I'm making this up. So when we look at, though, well, we've got a discrepancy here. We're paying 71.3 billion for Fox, but they only have 10 billion of identifiable intangible assets. What is this 61.3 billion? This is what we call goodwill. It is the excess between essentially the purchase price and then basically the identifiable assets. So the difference between the purchase price and the identifiable assets is going to be the goodwill. So if we look at this as 71.3 billion, and then the identified assets, again, I made this up for the intangibles, was say 10 billion. That essentially means that the goodwill amount was 61.3 billion. So is goodwill an asset? And the answer is yes, right? Because goodwill gives us future economic benefit. Because if Disney was able to basically take the Alien franchise and turn it into theme park rides, or they took more of the Marvel stories or different characters that they purchased as a result of acquiring Fox, there's tremendous value to that property, right? Is it worth 71.3 billion? Only time will go through and tell. Another company we could go through and look at would be Meta Platforms. Meta Platforms, formerly known as Facebook. if you go back and look at their early balance sheets, what you're going to notice is that they've got about 19 billion of goodwill, which was really from acquiring Instagram. I always want to say Optimus Prime, but it's actually Oculus Rift. But they bought all these different companies, and then you look at how they've taken that goodwill and perform with it. It's been pretty phenomenal. So that's essentially what goodwill is. So the key is when we're going through and dealing with goodwill is we're going to go through and look at the balance sheet, but then we're going to kind of go through and hire an appraiser to kind of go through and kind of see what the value of it is. So right over here, we were given this question here is that we have YYZ purchases the assets of PDX. Balance sheet for PDX as of 8/1/28 was as follows. So we have here, we're acquiring, getting cash, receivables, inventory, equipment, total assets of 3.55 million, accounts payable, notes payable, total liabilities, owner's equity, common stock, and the like. So when we're going through though and doing an acquisition, we really do not care about the owner's equity portion. So we're just going to kind of cross that out. But what we do know though is when we look at this, when we're buying a business, that we look at our famous equation right over here. We've got our assets are equal to our liabilities plus our owner's equity, expenses, revenue, debit, and credit. We're buying the assets of PDX, and so we need to go through and prepare. We need to go through and prepare the journal entry for the acquisition. So on 8/1/28, right, I know that my cash is going to be going down by $5 million. Okay, so I know that my cash is going down by $5 million. So I'm going to show a credit to cash for $5 million. Now, at the same time that I'm crediting this cash, I'm buying these assets. I'm also acquiring assets, right? And when I acquire assets, well, it looks like I'm getting cash over here of 1,250,000, and you do not want to net this out. You want to show it separately because once this cash is paid into escrow, then this cash becomes ours, but it's not ours until the transaction actually closes. But here's what's really important. Everything here you're looking at, these are all book values. We don't care about book values. We basically care about what they're actually worth. So we're going to hire an appraiser, and then we kind of get this information. So first thing it tells us that PDX has a patent that has a fair value of 120,000. What is a patent? It gives us an exclusive right to basically to manufacture or basically produce a product for a certain period of time. So we're going to call this a patent. It's an asset for 120,000. Okay, so we're kind of going by here with the appraiser. Now it tells us here that of the 500,000 of accounts receivable, we're only expecting 450,000 to be collected. So over here, we're going to record accounts receivable net at 450,000, right? This is the book value. We're more focused on what the appraiser tells us. It says that the equipment has a fair value of 2 million. So over here, equipment. It's called accounts receivable. So equipment has a value of 2 million. Now you might be asking yourself, well, why? How did that happen? When equipment is originally recorded on our books, we are recording equipment at historical cost. So if we buy, say, a house in Irvine, and we bought a house in 1970 for 60 grand, today that house has got worth, I don't even know how much, it's worth a lot of money. But that's the one thing about accounting is one of our limitations is with, especially when it comes to equipment under GAAP or generally accepted accounting principles, is that we are recording things at historical cost. So we're going to basically record the equipment, though, what the appraiser tells us to do, essentially at fair value. Then it also tells us that the inventory has a fair value of 425,000. Okay, so again, we're just putting in these values here. So cash is cash. We've dealt with accounts receivable, inventory, and equipment. Also here, assume that we're going to assume all the liabilities of this company. So as we're assuming the liabilities, we're going to have to pay those back. So we're going to go ahead and record these over here as accounts payable and then as notes payable. Right? If we're assuming a liability, how do we go through and record a liability? Well, we're going to increase those with a credit. So now, what I've effectively have gone through here and I have done, right, is that when I go through and basically making this journal entry, I've got basically either the cash, the patent. Remember, with a patent, if a company creates a patent, they're generally only allowed to record on their books the value of the cost to defend it or to, when it comes to intellectual property, it's really the cost of defense if it's self-created. However, when you buy intellectual property, you can absolutely go through and assign a value, and that's what the appraiser would be doing for us. So here we've got the cash, the patent, the receivables, the equipment, the inventory. So again, we're using the fair values. And then we also have the notes payable and accounts payable. Now, this common stock and retained earnings and all this stuff over here, we do not care about. That was with the prior owners. We're not assuming any that we don't put in their common stock or their retained earnings. We just don't care. So now when it comes to this, I now look at my journal entry and I look at all my assets that I've gone through and recorded, and I look at all my liabilities. Right. So I've got over here about 6.4 million worth of liabilities. I subtract these two and I'm coming up with, well, my journal entry balance does not balance by 2.1 million. This amount here is going to be my goodwill. So the way you want to go through and to do this question is we want to go through and list out the fair values of everything we're acquiring, right? So we're going to list out those fair values first. We want to show that cash going out for the purchase price. We're going to show those liabilities we're assuming. We're going to go ahead and list out the inventory at fair value, the equipment at fair value, the accounts receivable, the fair value, patent, and the cash. So whatever I need to do to balance is going to be my goodwill. So when I'm asked to go through, prepare the journal entry, it's really to record the acquisition of PDX by YYZ. That's really what we're kind of going through and doing over here. Right. So this is kind of this is how we're going through and doing this part. So the next thing that we're going to kind of go through and do is the next question is being asked is assume that the patent has a legal life of 12 years and a useful life of 15 years. Prepare the journal entry to record amortization expense for the year ended December 31st, 2028. So when we look at a patent, and this is what's really important. So over here on 12/31/28, when I'm amortizing intellectual property, so a patent, trademark, copyright, we're going to do it over the lesser of I'm going to amortize it over the lesser of the legal life or the useful life. What is amortization? It's a fancy way of saying depreciation for patents, right? We call it amortization expense because it doesn't have any true physical substance. It's obviously its legal rights. So what I'm going to go through over here and do is I'm going to say, well, the patent that we acquired had a value over here of 120,000. Right? So that was the value, the cost of that patent. Okay, so now the next thing is, the next question is like, well, here's the cost of that patent, and then what is the amortization period? So the estimated useful life is going to be 12. Why is it 12? It is the lesser of the legal life or the useful life. It has a legal life of 12 and a useful life of 15. So the annual amortization expense is going to be $10,000 per year. Okay, so that's my annual amortization expense. Now, when I look at this over here, when I'm preparing the entry as of 12/31/28, I have to ask myself the question. It's like, well, did I use it for the full year? The answer is going to be no. I used it from August 1st through December 31st, right? So I need to multiply this by 5/12, or from August 1st through December 31st. I'm going to get a nice, good job, Tchaikovsky. I should have used 10, but I used 12. It's fine. So I'm multiplying this by 5/12. And I get 4167. So if I need to record amortization expense, how do I record it? Well, I record expenses with a debit. So over here, I'm going to do amortization expense for 4167. Now, for the credit, I really have two choices. I personally prefer accumulated amortization patent. The reason why I prefer this approach is that it's essentially keeping track of basically the amount that I'm amortizing the patent by, or I could just credit the patent directly. Either one of these would be acceptable. But again, if you're showing this, as you can always kind of go back and check later, like, well, I'm not directly, it's a long-term asset. It's not like, insurance, like an insurance policy. But again, so this is going to be to record amortization expense. So that's the first part of our question. And I'm going to come back just shortly and we're going to talk about the impairment of this goodwill on the next video. Have a great day.